What was your thesis about the name going into the issue last week?
Well, there were really two concerns that we had and that we think were shared by many other institutional investors, particularly pension funds. The first was that Lyft chose a governance structure in which the two founders of the company were getting basically 10 times the voting power of ordinary public investors. And we, along with a lot of other institutional investors, objected to this. We don't like to see dual-class structures of this sort in general, but the Lyft structure seemed to us particularly egregious, in part because there was no sunset on the extra voting power for the founders. Many other companies that have gone public with the dual-class structure have put something like a 7 or a 5 or even a 3-year sunset on that extra voting power. But beyond that, the fact is that these Lyft founders had already sold the bulk of their shares in the company to private investors, and the private investors had been holding the company on a one-share, one-vote basis for many years. So in our view, the stake that the founders had in the company was so small, below 7%, that it really was not justified giving them majority or near majority control through these voting provisions. Our other concern was about yeah, go ahead.
I was going to say ownership structure, obviously a worry, but any thoughts about the nature of the business?
Indeed.
Their market share, their pricing power, their long-term viability?
Significant concerns along all of those dimensions. Lyft, as you know, hasn't ever made a profit. But more troubling, Lyft hasn't been able to charge prices which cover even its operating costs. So Lyft's price per ride is higher than its cost per ride, and the price per ride has been growing less quickly than the cost per ride over the last year. It's very hard to see how a company is going to be profitable at some point in the future when it is unable either to charge more than its costs or unable to even get its costs under control so they're growing less quickly than prices. So we believe further that the frustration that many Lyft drivers have over the very low return that they end up getting from being a driver, once you take into account all of the fixed costs that they have for the car and fuel and insurance, there's a lot of efforts around the country to introduce rules and regulations on ride sharing, which make certain that drivers are going to be earning a viable income. We've seen that with the minimum wage rules in a few different states. We're seeing that with the changes in the interpretation of who's an employee and who's an independent contractor in California and a few other states. Yeah. We're seeing that with concerns around ride sharing that are not necessarily connected to the driver's pay, but connected to the impact of having so many additional cars out on the streets driving around looking for fares. And that's congestion pricing, which New York just adopted, as well as concerns around greenhouse gases. Go ahead.
So, Richard, I know you're not managing money, but you are advising pension funds when it comes to companies like Lyft and those stocks. So how much of this is a Lyft-specific story in your viewpoint, and how much of this is sort of setting the stage for all of these big tech IPOs that are expected this year, other ones that aren't profitable or maybe have questionable business models, at least in the near term, or that have dual-class share structures, et cetera?
So I think on the dual-class issue, that's going to apply to any of the companies that choose that structure. We have heard, we think pretty persuasively, that Uber is not going to choose a dual-class structure. We don't know about other companies that may be looking to go public a little later in the year. But if they go down the road of dual-class, I think they're going to face a similar level of resistance and frustration that Lyft has encountered. In terms of the economics of the company, I think that it's something of a case-by-case issue. But as you suggest, it's not unusual for these tech companies that establish a platform which faces both consumers and the providers of labor services to operate below cost, essentially, to charge prices below cost and not to earn a profit. It's very hard for us to believe that it's a good idea for a long-term investor like a pension fund to put their capital into a company like that when there isn't any credible description from the company itself of how it's going to get to profitability.
So should other potential investors in these stocks, be it Lyft or some of the other names expected to go public this year that might raise similar issues for you, should they be aware that maybe pension funds are not going to be investing in these names? Because that's a sizable amount of institutional capital that may not be coming in.
Well, I think that they should recognize that pension funds are paying attention to the long term and that these companies don't have a credible theory of the case for how they'll be profitable in the long term. Until they can come up with that, I don't see why pension funds would be putting their money in. And when we're talking to those funds, we're going to make our point of view very clear. So I think that any company looking to go to an IPO this year has to put together a credible theory of the case of how they will get to profitability.
I mean, the name was still way oversubscribed going in, and although it is down, it doesn't seem to be so extreme that it would knock the habit of private companies from demanding these types of structures, don't you think? I mean, it's just
but
hard
remember
to believe
that
behavior
they only
changes because of 2 days on an IPO.
But they only floated 30 million shares out of about 280 million shares. So only about 10% of the company is trading right now. All of the private investors that have been buying shares in Lyft over the years are going to be looking to sell those shares and to be making enough of a return on those sales to be able to hit their required rates of return for their limited partners and the funds that have invested there. So if there's not a lot of enthusiasm about buying Lyft at a relatively high price, given the fact that they aren't profitable and have no credible theory of how they're going to get to profitability, I would be very concerned if I were one of those general partners with an investment in Lyft or in another one of these tech companies about whether or not I'm actually going to be able to cash out and report back to my limited partners.
If you had to guess, if you were managing Uber's new issue, what percentage would you take off of the range going in as a result of the Lyft action?
Well, I think that you need to have, again, I don't think it's an issue specifically around the IPO pricing, because it's not an issue around what happens in the first day or week or month. It's about having a credible theory of how you get to profitability. And so if I were Uber, I would be making the decision, I think, and encouraging other people in the company to really focus on how we present a credible case that we're going to be a profitable company going forward. Whether that's because you're going to be able to raise prices because of a dominant market position, maybe it's international growth, maybe it's growth in some of these other segments that the company's moved into, maybe it's a different relationship with the drivers, which enables the company to benefit more from productivity.
Anything other than saying we're not going to make profits for as far as the eye can see.
Exactly, yeah. Or that somehow magically, or inventing a new metric that sort of somehow suggests that you're profitable because you're ignoring a significant segment of your costs.